Hi, everybody. This is Dan Sheridan from Sheridan Risk Management. And today I want to talk a little bit about a spec trade that many years ago, I would guess over a decade ago, I labeled this the time bomb butterfly. This was popular. These type of trades were popular in the pit when I traded at the Chicago Board Options Exchange for many years. But I think they're what I like about them is they're cheap directional shots. And I'm going to show you in a $5,870 vehicle like SPX, how I can take a cheap shot for a buck, $100 in a $5,800 vehicle. I like these much better yield potential than a vertical put debit spread or a long put. So here's the scenario. So you look at the market last week and it's okay, we finally, right? It's like at your house, you've gone months and months without rain. Finally, it rains, and you're happy about that. But we're never happy. It goes down in the market usually. But if you're long stock or something, but so we're down below some of the shorter term moving averages, and it looks like it could continue a little bit. So if you were to say, you know what, Dan, I think so. There's two things going on. I think we can continue down. There might be from a technical pattern, you could say you might fill the gap at 57.83 or near 57. So 57.83. So for a whole number near 57.80. The other thing you can say, which I look at more, is something like an expected move. Where if SPX closed at 58.70 Friday, where does the expected move that could be for SPX for next week? So to give you an idea, you look at Friday, November 22nd, the expected move is plus or minus 97 points. Let's round it to 100. So we have this 57.70, 59.70. So that's like one standard deviation. So what are we saying? We're saying there's a 68% probability we're going to be between 57.70 on the downside, down about 100 from where we closed Friday at 58.70, and up 100 at 59.70. The last 2 weeks in the SPX, we finished outside the expected move. Right? It's moved a little bit too far. The previous 6 weeks were glorious. We finished in the expected move, and they were wonderful for range-bound trading, leading up probably about 6 weeks up to the election. So not only do you have this, and again, you can go upside or downside. I'm just picking this strategy, giving you an example on the downside. If you believe from a technical, we could fill this gap in the SPX maybe around the 57.80 level. And you're seeing the expected move is up or down about 100 points. If I look at 58.70, I'm doing a butterfly here. I'm going to put my short strike at 57.70. All right. I'm going to put a long put so I'm going to sell 2. Put my long put at 5,800 before it, 30 points before it. And then put another long put 30 points below my short put at 57.40. So I would call this a 30 wide time bomb. Why did I start calling them time bombs a long time ago? Because you place these little cheap butterflies, it's $100, and they could grow, if we're in this landing area, 57.40 to 5,800 as the week progresses, right? I'd rather it there by, Wednesday or Thursday. This T+0 graph will raise higher. And you can see, yeah, conceivably you can make 2, 3, 4, 5 times your purchase. But again, the key is Evel Knievel needs to land in this landing area. We need to get it to Wednesday, Thursday, Friday would be ideal. But you can see it's a much better bang for the buck than a long put or a put vertical debit spread from a yield point of view. But if we just go down quickly or we're going down, you're getting more short delta on the vertical debit spread or long put. So that can do better, but it's not going to have the yield, right? The nice thing is you're only leaning a half a delta short. So it's, even if we're wrong, it's much less a problem than a long put or a put vertical debit spread. So I would be looking at this minimum to look at, 40, on the low end, 30%, but generally 50% or more. Now, if I do 4 of these, right? If I did 4 of them and I'm up 30 or 40%, I may take profit on 2 and leave 2 going. Now, but you can do this either side. You can, for next week, if you think more bullish, you could set a 30 wide call butterfly up 100 points. So that would be at the 59.70 strike. So you could do either way, right? You can do both, right? But here would be on the call side, 59.70 on the upside, go up 100 points. Down 30, 59.40. And then up to 6,000. So this is how it would look on the upside if your views were maybe more different or contrarian or whatever you want to call it. Again, we closed yesterday, Friday, at 58.70. Now, generally, we do butterflies for range-bound trades. And that's a pretty prominent strategy that we do, but this is using a butterfly in a little more directional view. And these time-bound butterflies are wonderful, but it's speculative, right? Now, the upside, the call butterfly costs $2 if you set it up at 59.70. The put butterflies at $1. If you had them both linked, you have something that looks like this. And that's something, if you don't know, you could put on, this would be a speculative move. And what's nice about this speculative move, if you do both, it's a positive theta trade, right? Or you can do speculative and, if Evel Knievel gets in either of these landing areas on the upside, 59.40 to 59.96, or on the downside, 57.40 to 57.93, as you start getting to Friday of next week, these purple lines will go into this profit area pretty good. So something to think about. Cheap shots, great yields, and they're a little more forgiving. You can get out of it Wednesday or Thursday still with a few dollars, but it's a spec play. But it's something I like to do, probably my favorite spec trade, just because they're less risky than just buying a put or buying a put vertical debit spread. But, if you're right in the market, it gets slaughtered, you would wish you were in a long put or long vertical debit spread. But when you're wrong, they hurt a lot more. So anyways, folks, have a good day. Check us out at SheridanRiskManagement.com. If you have any questions, I'm Dan at SheridanRiskManagement.com. Have a wonderful weekend. Thanks.